Good afternoon, everyone. Good to see you. I'm really delighted to be here with Richard Kauffman from New York State, my home state. We're going to talk a little bit about the future of the utility and power sector and how we open it up to more clean, distributed energy. I'm going to start kind of on a personal note, Richard.
Please be personal.
Please be personal, because I think folks here will be interested to know about your journey. You were an investment banker at Morgan Stanley, at Goldman Sachs. You went on into private equity, running Good Energies, a major investor in clean energy. You were then a senior advisor to Steve Chu, the Secretary of Energy. And then the calling of service in New York came. Governor Cuomo asked you to take a new role, which hadn't existed before. As Adams called it, the green czar or the energy czar. But I think, more specifically, overseeing 5 different agencies that hadn't had coordination really before that, right? And those are NYSERDA, the Public Service Commission, LIPA, NYPA, and there's one more, maybe. But tell us about why you did that and what it's been like now 2.5 years into them.
Okay, so I guess my first, if we're going to be personal, my first exposure to renewable energy was the year of the first energy crisis, which is when I was a freshman in college. And so it had always been an interest of mine, and when I had the opportunity to take over Good Energies, I thought the issue was, we hadn't made much progress, I thought the issue was one of technology and failure to invest in technology. And it was pretty clear after I got into it that there were real issues with development of markets, and that, in a sense, the problem was less about the technology itself, but an inadequate connection between the innovation engine and markets. So Moore's law is not a law of physics, it's a law of markets. And we had not created that kind of dynamic where there'd be markets, and in fact, government, in its own kind of well-meaning way, was actually impeding the development of markets. So I'm a Democrat, lest there be any doubt about my politics. But we give tons of grants. So energy efficiency is an example. We give 70% of the houses in New York State are more than 70 years old. But so we think a lot of opportunity for residential energy efficiency. And we'll pay for an audit and up to 20% of the cost of the retrofit. And at the current rate of penetration, it'll take 500 years to retrofit the housing stock. We give out LED light bulbs. So we constantly are intervening in the part of the market where there's the highest payback, which is actually where the private sector would intervene. We do this in the form of grants. And so we're not building a really integrated network grid. We have the traditional central station, distribution system, and then through grants we bolt on these distributed solutions. That's not making a market, and it's not building the energy system that we've seen the pictures of a million times, this thing that looks sort of like the IT system.
Right. So you're taking, it sounds like, the tools of the private sector investment world, banking and private equity, and trying to create market conditions, market stimuli, competitiveness in a sector that hasn't been very competitive. You've created this thing that most people here have probably heard of called Rev,
right.
Reforming the Energy Vision. What is Rev, and where are you in the process of rolling it out?
All right, so Rev really aims to take on the basic problem that we're not on a sustainable course in our power system. Because we have a power system that is getting more and more expensive, so we have real affordability issues, not so much maybe if you're in a high-end part of Manhattan, but you go to other parts of the state, there are going to be increasingly affordability issues. It's not sustainable from an economic development standpoint. There's a tremendous opportunity to rebuild this really old electricity infrastructure. And it's not sustainable from an emission standpoint, and it's not sustainable from a resiliency standpoint. We had Hurricane Sandy, and it was brutal for communities across the state. Actually, it wasn't just Sandy, it was also Lee and Irene. So it's everywhere in the state has been terribly buffeted. So we are aiming to create a system which is more affordable, will create more economic development, be more resilient, and give customers more value, and it will be cleaner to boot. So I actually this is, the calling myself, I'm not the green energy czar, I'm the energy czar.
Yeah.
And this is really a case where there is so much potential value that we can, there's a huge cost envelope already in terms of what we pay for electricity. If I can't help myself, I'm sorry. But when you talk about markets, the utility sector has been hidden, protected through the regulatory compact from the most significant business trends that have happened during my career in the last 35 years. All right, so it's still a production-led system as opposed to a customer-centered sector. I mean, every other business, has been re-engineered so the customers at the beginning, and you work backwards. We still call them ratepayers. Okay. Capital efficiency. I did have some career in investment banking. That's what investment banking has been. That's what private equity has been. That's what so much financial engineering has been helping companies become much more capital efficient. Returns on capital have gone up dramatically through changes in business model, adoption of technology, and changes in financial incentives. The average capacity utilization of the utility sector in New York State is 54%. 54%. You look at other capital-intensive industries, they're in the high 80s. They've evolved in the last 30 years.
So this is why you've gotten a reputation as the guy who is essentially trying to reform the entire utility sector.
Yes.
I now remember what that fifth area you're responsible for is. It's the green bank.
Right.
Maybe fold into explaining, A, what you're doing with utilities, and how does the green bank fit into this whole REV vision?
Okay, so I'm sorry, I went on a jag there, Andrew. Forgive me.
It's all good.
So I think really the point is that we're looking to utilities to, again, in New York State, utilities don't own generation, so the distribution and transmission companies, we're looking for utilities to operate, in addition to delivering electricity, they have to operate a platform that is more capital efficient. I have an example that we can talk about that they integrate distributed resources where it's going to make sense for the system as a whole, not just for the customer, to procure more energy efficiency and demand response, and to promote competitive markets. And we're saying that utilities, with very rare exception, can own distributed energy solutions. So we have to turn these things into a different business because the utility business model is about putting capital to work, and we're actually saying to the utilities, we actually want you to be paid for deploying less capital. When we think about demand response, that's not a business for a utility. That's a matter of compliance. Delivering more energy efficiency to customers, or more clean energy, that's not a business either. That's all compliance. So it's turning the business model in a way so the utilities can get paid more in non-traditional ways. And there are certainly ample opportunities for utilities to be paid through earning fees from third parties, customer origination fees as an example, through the ability to create data, billing services. They have credit information on every customer that can be monetized. And then there are all these expenses that they incur and that are pass-throughs where they get cost recovery, where there could be opportunities for shared saving contracts. So when the utility industry says, well, we don't know how we can make money in a different way, they can make money in different ways, but it requires a meaningful change in sort of business strategy and culture.
You were speaking recently to a group of regulators in the utility industry. You said, look, this death spiral thesis may not be right. But there are going to be, and you use this term, some zombie utilities. What did you mean by zombie utilities?
So what
Walking Dead?
Yeah, I guess that would be the accepted definition of zombie. I don't think that the most likely circumstance for most utilities around the country is that there's a death spiral, because distributed solutions are still going to be a very small percentage for a very long period of time in utilities, and they still have lots of capital that they need to deploy, particularly in places like New York where the infrastructure is old. So that's not really, I think, the risk. I think the risk is to the utility industry is that if the utility industry doesn't change, what's going to happen is you will have erosion of customers that will take on distributed solutions. You will have continued cost pressures on the upside, because that's what's happening. Generation costs are declining, but T&D costs continue to generally increase. And so what that's going to mean is that in spite of everybody's best efforts, there's going to be regulatory pushback, because the combination of erosion of customers and increases in costs would mean upward rate pressure. And so regulators are going to tend to push back, and that's going to tend to lead to, at the margin, erosion in quality of service. And that's going to tend to, over time, lead to more customers leaving. And so really what happens is a business and that's going to be harder then, of course, to get further rate increases. And so what that means is over time, a business which can never get the capital that it needs to get into the future, and it's going to have a tremendous difficulty being able to attract people into the business. And that's a business that isn't going to go away, but it's certainly not a very attractive business to be in.
So we're going to jump into that in a minute. I want people to start thinking of questions. We do have some utility leaders here. I know we had a couple CEOs and other folks representing the industry, and it would be great to get their questions. What is an example? You mentioned there was one
in Brooklyn,
where you've had a success story. Yeah, tell us about that.
All right. So in part of Brooklyn, there's load growth, and
hipster load growth.
Absolutely. And so Con Ed would have embarked upon $1 billion plus substation to solve that load growth, and instead, with our encouragement, but they deserve all the credit in the world. You know, if you create a regulatory and policy framework for innovation, there are some people that are going to take advantage of going through that door. And so Con Ed said, well, okay, we're interested in experimenting here. So they went out and instead are going to use a range of distributed solutions that would include CHP and solar and energy efficiency and demand response, and it's going to cost hundreds of millions of dollars less. So the benefit to ratepayers, to customers, is there's less capital deployed, there's less peak power produced, so that saves procured, so that saves customers money, and it's going to have fewer emissions. So this is an example where it really is a win-win-win. Now, what we have to work out over time with this is two things that are related, or two things. One is how the utility gets paid appropriately for committing less capital. The second thing is that it's easy to look at areas where there's load growth, but 70% of the capital that's deployed in New York State is just replacement of capital. It's not load growth. And so really the same theory ought to obtain. If I know that I've got a substation that I'm going to have to replace, or another piece of equipment I'm going to have to replace because it's coming to the end of the life, how can we come up with a solution that's less capital intensive? And so that's really where we need to go with the utilities next, not in the areas of where there's low growth, but replacement capital. The other thing that I think is interesting is the open source nature of what Con Ed did, which involves another element of cultural change, because typical utility approach is we know what the problem is, we're going to go procure what the answer is. And in this case, Con Ed went out with the problem. And I think Con Ed was surprised by the range of solutions it got back from the market. And that's really a fundamental change in process. That's true not only at the utility, it's got to also be true at the regulator. You know, I think over time, regulators have to move from it being a judicial type process to being more a role of a market monitor. IRPs, which are integrated resource planning, and really should be a dynamics process where many parties can come in from a market to give their perspective on how they think a system ought to be deployed.
Do we have questions from the audience? Any folks? Yes, sir.
I recognize Derek Kirkland.
Wait for the mic there. Thank you.
Derek Kirkland from Morgan Stanley. Richard, what I'm missing is the heart of, what I think is the heart of the model you want to go to, which is what's the revenue and profit model for the utility when they're half rate regulated and in part not, and how does that transition work? Because if you want them to do all these good things, they're not going to get paid by traditional regulation to do that. So it strikes me as a complicated question to figure out how to pay them appropriately, keep them in business as grid managers.
Okay, so thanks, Derek. So and I also want to make this clear that I know that some people say we're moving too fast, and other people think we're moving too slowly. So we are moving in a deliberate way, and one of the ways in which we're moving in a deliberate way is not only through the traditional regulatory process, but also through demonstration projects. Because you can get into a kind of do loop, existential debates about the utility end state, and there are a million of these confabs about the future of the utility industry. So the point about the demonstration projects is we've created an opportunity for utilities and third parties to come forward with ideas to start working on today, where they can work together and offer a value to customers and can create different kinds of revenue opportunities for utilities. And so in July, there were 11 of these projects that were first brought forward. I don't think there have ever been as many demonstration projects ever done by as many utilities, and that's an ongoing process. So we have more than a lab, because we're calling them demonstrations as opposed to pilots, because if they work, we're going to deploy them across the state. So that's one point. The second point I'd make just quickly is if you think about the utility bill for a second. So the portion of the bill on which the utility makes a profit is that portion which largely relates to capital. That's it. That's a tiny percentage of the bill. So if you think about, so let's just think about a solution that involves load shifting, okay? Solar, for example, solar and batteries. Well, that's good for the customer. But how do we make it good for the whole system and good for the utility? Well, if we work backwards across into the utility operations, well, the first thing you say is there could be less capital deployed. All right, so again, we have to have a model for figuring out how to pay the utility for that. But you come from the financial engineering world. You can imagine a kind of contract that the utility would enter into for value received from reduced capital being committed. And then let's go and say, well, the system is running less hard, so there are less O&M costs go down. Right now, O&M costs are just cost recovery. So there's an opportunity for shared savings. There are line losses. Right now, line losses are not captured in the system. There's an opportunity for shared savings there. And ultimately, it turns into capacity payments. Capacity payments are a pass-through, again, on the bill. Let's have shared savings there. So there's a tremendous opportunity on the whole bill to help utilities get paid in unconventional ways. And so I think what we really need to do is, again, open up the system to all the things that have happened in other industries that have not occurred in the utility sector. If you think about companies that have been in commodity-like businesses, for the last 35 years, they've generally faced tremendous pressures to reduce their costs because they faced price deflation. So they've had to lower their costs and try to improve value added to their customers. The provision of electric services is probably the only commodity I can think of. What we do with electricity is valuable, but it's probably the only commodity I can think of where costs have gone up and the industry has not evolved to improve its value-added services.
We may have time for just one more quick question.
Sorry, I didn't mean to talk so long.
Richard is working on the democratization of power here. It would be interesting to see how it unfolds and whether we figure out those financial models. Are there any other questions? Yes. No time, I've just been told. All right, we need to wrap it up. Please thank Richard Kauffman.